Hello, all. Bob Pisani here. Welcome to ETF Edge, your go-to place for everything exchange-traded funds here. SPACs and active management are topics today, and all this craziness in the markets here. Three of the best in the business with us. Bob Shea is the TrimTab CEO. Ben Johnson is the head of ETF research at Morningstar, and Mark Yusko is the CEO of Morgan Creek Capital Management. Bob, I want to start with you. There's a lot of craziness in the markets today. We were just talking about it on air. You were the head of Goldman Sachs equity desk for 14 or 15 years. You've seen a lot of craziness yourself here. We saw today Apple getting thrown around like a rag doll. It was 136 to 145 an hour for the biggest company in the world. GameStop goes parabolic, then all the way back down, halted numerous times throughout the day. What do you think is going on here? There seems to be a little bit of a market issue with concerns about the COVID vaccine narrative changing a little bit. Some concerns maybe the stimulus program is not as certain or not as big as people think. And other people are saying, well, there's a sideshow going on with people trying to play the lower price stocks and the stocks that have been heavily shorted. Can you spend a minute and just sort this out for us?
Yeah, terrific. Thank you. First, thanks for having me, Bob. And yeah, I ran Goldman's equity trading desk back in the dot-com days as well. My desk was Cape Canaveral for a lot of the dot-coms, and as we've seen, there've been a lot of people writing and talking about the similarities between them then and now, and there are definitely some similarities, no question. But there are some big differences in the environments. But specifically to kind of the action we're seeing today, I think we're seeing, definitely speculative activity that's more based on positioning, options positioning, and shorter-term euphoric kind of sentiment, and we're seeing that bubbling up. Obviously, we have money supply, which is making new highs on a regular basis. And so on the one hand, there are some similarities. On the other hand, there's some glaring differences from back then. The interest rate environment is completely...
Well, yeah, I guess, and feel free to jump in, Ben or Mark, but the similarity that I see is people are still reacting to the same euphoria. This manias still happen. That dopamine rush that people still get in their heads that we saw so notably in 1999 when you were around, Bob, and I was reporting on this as well, hasn't changed. A whole field of behavioral economics came out of a lot of this, studying how people react to euphoria and to manias, and how people react to bubbles in general. So that certainly sounds very similar to me. What's different is the technology is very different. When people opened their DLJ accounts in 1998, it was pretty cumbersome. You could get a confirmation. It would take 20 minutes to move the next day. Today, you're sitting in a bar with your boyfriend or girlfriend and your Robinhood account, and you trade stocks like you're on FanDuel, like a sports game almost. It has similarities. Isn't that the difference here this time? It's a lot easier to do this.
Yeah. Back then we had chat rooms, if you remember, for the IPOs, where we price something at 30, but it would open at 200. And that's where there's some similarities. You have, where there are these little pockets of, what we're seeing in these short squeezes. There's definitely some speculative activity. What is most glaring right now is kind of the one-sided options positioning, where perhaps some of the cohort of investors that you were speaking to earlier are using leveraged options plays to express bullish views in a lot of these stocks and a lot of kind of the NASDAQ. What's very different is the interest rate backdrop. Very different. What's very different, we focus on free cash flow at TrimTabs, and I'll just tell you that the NASDAQ 100 from 2000 to 2021 is very different. From the percentage of the NASDAQ 100 that is free cash flow or cash flow positive is 99% versus 80%. Free cash flow margins and free cash flow yield just much, much healthier. Now, does that mean we can't correct? Absolutely we can. But the speculation, it's not like if I look at the big glaring divergences that occurred towards the end of the 2000 into 2001, and they just don't exist with regards to credit spreads, et cetera, and big breadth divergences. Yeah. What we have, and I'll finish on this, is literally that what we have is this. It feels like the beginning stages of a long-term recovery on the one hand, and then this kind of very speculative action that we're seeing in the last few days.
Yeah, that sounds right to me. Mark, I want to talk to you about SPACs, but I wonder if you can react to what Bob was saying there. I think he brings up a good point. There's obviously the start of a long-term recovery, and yet today it feels like a blow-off top, kind of, in a way. I know we're supposed to talk about SPACs here, but any thoughts about what's happening right now?
No, we can definitely get to SPACs, but definitely have a reaction in that, the gamification. I think it's interesting that we're talking about GameStop all morning in a world where investing has truly become gamified. People were in lockdown. They couldn't bet on sports because sports wasn't happening. And suddenly DraftKings and others got people's attention focused on the market. So I do think we're at a speculative peak. I do think this could be, we don't know, but it could be that event, that seminal event that triggers some motion downward. But it is pretty wild, Bob. You're right.
Yeah, Ben, your thoughts. You're an old hand. You've been watching the markets for many years as well. How does this kind of is it a blow off top in your opinion right now, or is something else going on? And how does it affect the world of ETFs?
Yeah, Bob, I think the key term that Mark hit on is gamification. And what might be different today versus what we saw in 2000 is exactly what you've described. The fact that I can walk around with a supercomputer in my hand, make trades and make options trades all day, every day. In some cases, maybe allocating capital that arrived to me via a stimulus check into the markets, and see a little animated confetti drop out anytime I make some money in the market. That I think is only played on and really exacerbated all of those animal spirits, all of the worst of our behavioral biases this go around. And I think it's gotten to the point where, many professionals, many people watching the market, myself included, have gotten to the point where we're wondering, are we the crazy ones in all of this, or are we missing something that all these other people aren't? And, usually that's when, if you can't ring a bell at the top, it's probably a good time to start ringing it close enough to the top.
Yeah, we are. No, you're not crazy. And the answer to all of this is we have seen this before. And I feel like launching into, behavioral economics 101, but we don't have the time to do that. But this was all very well studied over the last, beginning about 1980, by people like, Robert Shiller and other people like that, and won Nobel Prizes for what's going on here. But I want to move on here. Let's talk about SPACs a little bit because, Mark, I've got you on specifically. You've got a SPAC ETF coming this week. I think it's the third one. This is actively managed now. We talked on the air about this a little, but what impresses me about this is 2/3 of the companies will come that you're picking will come from companies that have already chosen a partner, 1/3 from companies that are still seeking startups. What's amazing to me is how you make the decision on active management in this kind of environment and picking a company that hasn't even done a target yet. How would you even decide that? Tell us about this, how you're picking this.
Yeah, look, at the end of the day, it's about the people, Bob. People and management teams, the great ones tend to win. And so, the nice thing is ourselves and Exos, our partner, we've been doing this collectively for 5 decades. We've been partnering with management teams. We've been picking the winners from the losers. And I think the big opportunity here is to take this superior structure, which is if you're a high growth company of the future, right? A company that has really big upside and doesn't want the hassle of the traditional IPO process, doesn't want to be encumbered by not having the ability to make forward-looking statements. You have this wonderful innovation in SPAC structure that allows these companies to get public. And therefore, the great management teams, the ones that you want to partner with for decades to come, become pretty readily available for investors and pretty apparent to professional investors like ourselves. So we're excited to bring this active approach to a market that I think is really in its infancy. I mean, I said, when we were talking last week that, 2020 probably goes down as the year of the SPAC, right? More SPACs were issued, more dollars were raised, and there are those that want to call it a bubble. But it's not a bubble. I mean, a SPAC is a legal structure. It's like mutual fund or ETF. And the people that criticize SPACs today are the same ones that criticized hedge funds 10 years ago or criticized mutual funds 30 years ago. When lots of people like a structure and people have success utilizing it, other people, may not like that. So we're very excited about the opportunity, very excited about the market. And you bring up the most important point, and we've been talking about it with the craziness of the markets. The average investor has to navigate extreme valuations, extreme attraction of these markets for unsavory types to bring companies public. And by focusing on quality, focusing on the best teams and the best ideas and the best companies, I think you can get great returns.
Yeah. Focus on quality is all well and good, but it's a pretty confusing universe out there. I want to open this up to Ben and Bob's comments, but I want to first run a comment on the explosion in SPACs from former Goldman CEO Lloyd Blankfein. He was on this morning talking about exactly this. Let's run the bite and we'll chat on the other side.
If a few of these go bad or they were overpaid and some people made a lot of money and investors lost money, people are going to say, where, you achieve the economic equivalence of an IPO, but where was the process and diligence that we all associated with a rigorous IPO diligence process? And that kind of drops out. Now, I'm not saying that they're all bad or that any of the ones that you could bring up are bad. Some of these won't work. And my advice to people who are doing this now would be really, really diligent, really, really document. But, again, in hindsight, if something goes bad down the road, people will look back and, show trials to follow.
Yeah, exactly. So, Ben, let me get your take on this. We're going to now have 3 SPAC ETFs out there, but I think the relevant line here from Lloyd is we have the economic equivalence of an IPO, but where was the process and the due diligence that we see with the rigorous IPO process? Is that a fair comment from Lloyd Blankfein about the whole SPAC explosion?
Yeah, I think it's a fair comment, and I would argue that it's more so a functional equivalent of an IPO from an issuer's point of view. From an economic point of view and in the investor's point of view, most importantly, I think it's an IPO that effectively shifts more of the risk and potentially less of the return onto investors, that investors in this case, in the majority of these cases, will be the ones that wind up being the bag holders. Looking at research produced off the desks of my colleagues at PitchBook, they see this as a fleeting phase, as a means of raising capital that speaks to the moment that we're in and the difficulty that a lot of these firms would have going through the traditional IPO process. They expect that it'll come and go. And if you look at really the economic equivalent in terms of stocks that are already out there on the marketplace, be they stocks that came to market through the IPO or stocks that are simply smaller and have greater growth prospects, I look back at the performance of the oldest SPAC ETF, SPAK is the ticker there, which has only got a few months worth of track record under its belt. And its performance has been half that of the Vanguard Small Cap Growth ETF over the course of the past few months. And it's been half that of the First Trust U.S. Equity Opportunities ETF, which invests in traditional IPOs. FPX is the ticker there. So investors have to ask themselves whether it makes sense to arbitrarily limit their investment opportunity set to a handful of names that are coming to the market through a very novel means, and one, again, that probably is disfavorable from an investor's point of view, because there's a lot of value that accrues to the end investor through that normal IPO process, a very thorough vetting by many pairs of very well-trained, very detail-oriented eyeballs that are going to try to assess how much that thing's going to actually be worth at the end of the day.
Bob, can I jump in?
No, we put up. Go right ahead. Go ahead. Is that
Bob?
Is that Bob?
It's Mark.
Yeah.
Say I I just want to vehemently disagree there. What's interesting is a SPAC IPO is an IPO. It has been vetted. It is even taken public by many of the same firms that Mr. Blankfein refers to. It's typical commentary from an incumbent, right? SPACs took up over a quarter of IPOs last year. That means less business for the incumbent, so it's not shocking that they would criticize. The idea that this is bad for investors is simply not true. The average IPO, the average investor can't participate. Those IPO shares are allocated to the big fat cat clients of the big Wall Street brokerage firms, not to the average investor. A SPAC IPO, because it goes public at a $10 price, is available to everybody. And since you don't know what the deal is going to be, you don't have the speculative frenzy on the day one of trading. So you can actually acquire a position. Then when the deal's announced, again, by quality management teams of quality growth businesses, you've seen outstanding performance. So the last couple of months, not really relevant in performance terms. Look over the last year. Look at a basket of SPACs, more than double the return of the S&P. It's a fantastic structure. It's changed over the last 30 years. It's nowhere close to what it was in the early days in the 70s and 80s. And it actually is a boon to the average investor.
But there must, I think Ben's point is there must be a reason why suddenly SPACs have exploded so much. There is an advantage to the process for the people that are using the SPAC system. I think what Ben is expressing is some concern about that process. Are we going to be down the road 6 months from now saying, the SPAC boom has gone bust because so many SPACs came public that were, some would say, and Blankfein was implying, not necessarily ready to come to market? Is that a fair observation?
Again, I don't think it is by and large. I think as you and I discussed on Friday, of course, there will be people and management teams and sponsors drawn to this structure that shouldn't, and those will have bad outcomes. But is every IPO a good outcome? Not even close, despite the rigorous vetting, because at the end of the day, Wall Street gets paid to take companies public. So they're going to take companies public. It's like the old Doritos commercial, go ahead and eat them, we'll make more. And so at the end of the day, look at the companies that have gone public using the SPAC IPO. And you ask, Bob, what's changed? What changed really was Chamath and Virgin Galactic, where really robust companies of the future, these companies in electric vehicles, in video gaming and esports and e-commerce and space travel. These companies that if you had to have 5 years of profit, if you could only make commentary on historical revenues and cash flows, you wouldn't be able to do a roadshow and tell your story. What the SPAC structure allows is open-ended commentary about future story, and it gives these high-growth, great businesses a platform to, I think, bring what had been private businesses the opportunity to be invested in by the individual investor, which is fantastic.
Yeah. I want to talk to you more about that in the podcast, and Chamath and how it changed the business. But I want to move on a little bit and talk with Bob about active management. And Bob, this is a slightly different story, but you run an actively managed fund, TrimTabs, the all-cap U.S. free cash flow ETF. And you have been investing in, really, TrimTabs is all about free cash flow as the key metric. Can you very briefly just tell us why is that the most important thing to you? Is it even more important than actual earnings?
Yeah, as you know, management has great latitude and discretion in how they report earnings, and we at TrimTabs believe that free cash flow profitability, which is the focus of our investment strategies, our research shows that free cash flow profitability just generates a better risk-adjusted return compared to other other popular quality indicators like return on equity and return on assets, gross margins, earnings persistence, etc. To get into, we do proprietary quant screening of the Russell 3000, and nothing gets into our active ETFs that doesn't have very strong free cash flow scoring.
Yeah, so essentially you're implying free cash flow. It's harder to futz around with free cash flow than it is with with earnings, and that it's a pure look at how companies are doing. Is that the point?
That's the point. Yeah, and we have decades of research, that empirical research to point to that. Support
now,
that.
When I look at this, it looks like a high quality fund. So I'm looking at the top holdings here: J.P. Morgan, Apple, Morgan Stanley, Microsoft, and Amazon here. It kind of looks like a high-quality fund. What's the criteria for inclusion here? Is it just cash flow?
High free cash flows, quant scores, and in the case of the big financials in there, there is a more of an active macro tilt. As free cash flow is not, banks are not typically measured on free cash flow. However, with interest rates where they were when these went in, and then there's been some price appreciation. These obviously have great quality of earnings, but also, kind of an active macro tilt towards the yield curve, absolute level and steepening as it has.
Okay, going to have to leave it there, guys. A fascinating conversation. Sorry we got a little distracted at the top, but the market's crazy today. That's it for this week's ETF Edge. My thanks to Ben, Bob, and Mark. You can watch all of our shows, of course, etfedge.cnbc.com. And I want to remind everyone, the podcast, we're going to keep Mark Yusko with us for a few more minutes to talk about some more about the future of SPACs. 10 minutes with Mark on that. Stay with us on that. And remember, join us next week. We're going to be discussing high-yield investing using ETFs. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.